our next discussion, and this is going to be a conversation with Robert Leshner. So Robert's the CEO of Superstate, and Robert has an amazing background as the former founder of the DeFi exchange Compound Labs. He's also a venture investor with Robot Labs, and he's now leading as the CEO the company Superstate, which is one of the leading platforms for trading tokenized real-world assets. So he and I are going to discuss in a fireside chat format the outlook for Superstate. So very, very warm welcome, Robert. Thank you for being here.
Yes.
Yeah. No, it's great to have you because again, we're so lucky to have somebody that's, really at the forefront of technological innovation in markets. And so maybe just the first question for you, how do you explain, what you do to someone maybe outside crypto? Say somebody at a dinner party, what's the one sentence version?
The one sentence version is that we take securities that exist on Wall Street and we make them faster and easier to move around and more programmable with new use cases.
And so, okay, so I think that's a great summary of Superstate, what it's trying to accomplish. And then what was the moment when you personally decided that this is this really super interesting corner of finance? I'm getting in there. I'm focusing on this when it was probably like a lot less well understood and well known. So what was that aha moment?
So the aha moment for me actually started really in 2017. That's when I began building Compound, one of the first DeFi protocols. And at that time, the future looked extremely bright. And I was convinced that, shortly, we would have every security and asset operating on blockchains as tokens. I was too early, probably by about 10 years. But when I began building in DeFi, I thought that, very soon enough, we'd have stocks and bonds and currencies and commodities and real estate and everything else, existing as tokens on a blockchain. And over the next couple of years, that never really materialized. There was a lot of experiments and one-off pilots of real estate projects or, debt issuances, but oftentimes in extremely small sandbox environments. And they were very, they were prototypes, right? And over the course of about like 7 or 8 years, like there was very little, significant traction that was occurring in tokenization. And to me, this was always, a source of consternation. I always thought that by, building, in the crypto industry and on blockchains, like sure enough, like the types of assets that would be interoperable with these systems would just like scale up. And it hadn't really occurred. And around 2023, I was just still obsessed with this idea. And I decided to leave what I was doing building, a DeFi lending protocol to, take a stab at bringing securities from off-chain on-chain so that they could operate in this new environment.
Okay, so clearly there was a lot of, things to learn and to not learn from Wall Street in general. Are there any like one or two things that were sort of big insights for you or maybe even surprises when you started to compare and contrast Wall Street with how crypto exchanges, tokenization work?
Yeah, I mean, fundamentally, there's some incredible properties of crypto, and I'll start there. The first one is that anybody can deploy a financial instrument, right? When I say anybody, I mean like anyone listening to this conversation, right? Could go on the blockchain and make a token, make an asset. Whether it's worth anything, whether it has any, properties that people have come to expect is a different conversation. But the environment itself to create assets is extraordinarily permissionless. And the environment to interact with those assets is extraordinarily permissionless. And this leads to like really profound innovations and improvements. For those types of assets, DeFi has been able to prove out that you can have financial markets and financial products that operate 24/7, 365 autonomously in ways that just massively increase transparency and your ability to audit the financial market and understand all the different components of it. And so, we're starting off from just like an extremely openless side on the crypto side. On the security side, the traditional market side, I mean, it's the exact opposite. It's 180 degrees away, which is something that everyone who operates and works in finance, innately feels and understands is that things move slowly. Things are extremely regulated. Things are not permissionless. They're negotiated. If you want to innovate, most fintech companies, it takes a long time to make, honestly, like incremental improvements to the way financial products and financial markets operate, right? It's a very slow, velocity of innovation. And fintech companies that innovate actually can capture a lot of value by making small improvements slowly. And these two worlds are somewhat at odds. And so, the fascinating thing to sort of be in the middle of this and try to bridge it is that in some ways we're bounded by, you know, the existing system. When we're trying to take securities and bring them into a new environment, we're bound by all the same regulations, all the same compliance, all the same, you know, partnership necessity, right? To like work collaboratively with other, you know, institutions in the space in order to get things to be able to move faster and, you know, more autonomously and, you know, over uh, real-time, always-on infrastructure. And so it's kind of, in some ways, the best of both worlds and the worst of both worlds to be sitting in the center.
Yeah. So I think you're referring to the fact that everything's not exactly interoperable. You can't necessarily always jump from chain to chain. And if you go through all those steps along, even in one chain, you may be ending up in some hybrid situations. So for our audience, how do you think about that? Because it's really a technology strategy question for you. And maybe that would also explain a little bit about kind of your future design and what you're trying to accomplish.
Yeah, absolutely. So, you know, to talk about like what we're doing at Superstate at a very like fundamental level, you know, we record who owns securities and assets, right? Um, you know, the definition of who owns something historically is very contractual, right? It's not based on technology, right? It's literally just based on PDF contracts and spreadsheets and, you know, a judicial system to enforce agreements, right? That really bounds, you know, close to $700 trillion of wealth today. It has nothing to do with, you know, what's the technology behind it. It has everything to do with, you know, who entered into what agreement and how does it work and how many different, you know, intermediate, you know, steps of entitlement and contract are above that to create, you know, a system in which people own assets, they can move assets, and they exist. Um, and what we do at Superstate fundamentally is say, well, the recording of those assets actually uses technology more than the existing slash historical approach. And, you know, coming from that perspective, you know, multi-chain, moving things around systems, it's less about, you know, oh, there's different blockchains with different parameters, and just more about let's just try to get the ownership information in the first place into a modern blockchain enabled format so that it doesn't matter what ledger we're talking about. It doesn't matter where we want to move something. It doesn't matter, you know, the nuances of like the chain that hasn't been created yet. The fundamental ownership of an asset is ready to move between those systems.
I think it would be really interesting for our audience to hear about the assets you're most focused on tokenizing today and what your future plans are.
Absolutely. So, you know, we launched Superstate in 2023, and in the 2.5 years or so that we've been operating, we started off by trying to tokenize what I would call the simplest asset and asset class um, to create a token that's a security. And we started off with T-bills and a T-bill fund. And the reason for that is, you know, there's widespread understanding of how stablecoins work. Everyone loves them because they're global and portable 24/7. And it's just a better version of a dollar. And the simplicity of them is honestly, I think, the greatest selling point. T-bills are like 1 degree farther out the complexity curve in that there's very little, you know, negligible price risk, right? But there's yield, and you add a lot of, I'll call it legal and regulatory and compliance nuance because they're securities instead of just being a cash product. And so, you know, it's a great innovation space to build a tokenized product because it forces you to build out the end-to-end process of like, how do you take a security and turn it into a token and, you know, enforce everything that you need to enforce without burdening people with having to think about the actual financial product itself. Because everyone right now listening to this understands, you know, basically what they're getting with the T-bill. You don't really have to read the fine print on the actual economic side of the product. You just have to read the fine print on the sort of operational side. And so that was our first product. It's a phenomenal starting point. It's actually one of the reasons why a lot of the companies that enter tokenization start with a T-bill product, because the only thing you have to think about is the operational side, not the economic side. That was our first product. You know, from there we expanded into like, you know, a high yield fund. But funds are really, you know, what we don't consider our core focus to be. You know, funds are an incredible way for us to prove out to tokenization as an SEC registered transfer agent that partners with security issuers and has built a technology to sort of take a security and put it into token form. But the sort of holy grail that I think everyone is sort of fighting for right now, because I think it's sort of it's a massive opportunity that's going to be decided in the next couple of years, are public equities. And the reason why I think public equities are, exciting and going to be exciting in the next couple of years is because there's widespread demand to upgrade the way equity capital markets operate and equity, financial markets operate. It's kind of the marquee and flagship market of the US. It's what creates the most pride for, our country, and it creates the biggest tailwind for the success of everything that's ever been built here. And so, Superstate and a lot of other firms are right now focused on just how do we improve, equity markets through tokenization. And at a really high level, it seems simple, right? Right now, stocks are T+1. The process for them to move around is really cumbersome. I mean, moving a stock from one broker dealer or one individual to someone else is just, it takes days, right? It's clunky. It's not fun. Stocks don't seem like they're very digital, even though at the end of the day, everything that trades and everything that gets blottered, on NASDAQ or NYSE is digitized at this point. You're not trading, paper, you're trading zeros and ones, but it's still an inefficient version of the zeros and ones. And so, I think everybody sees this opportunity to move from a T+1 system to a real-time system with potentially much more favorable, capital efficiency, let alone speed efficiency, settlement efficiency, operational efficiency, increasing, auto automation, like all of these things. And so there's a lot of competition to solve the tokenization of equities. We're focused on it right now. Our approach is to do it a little bit differently than a lot of the other approaches to tokenization. What we do is we partner with issuers as their transfer agent and become the canonical record of their shares in token form. And so there's a lot of other approaches. There's, an approach above the transfer agent layer where most shares are held by DTC. So DTC is saying, well, how do we tokenize shares? There's broker dealers that sit above the DTC. They're saying, well, how do we tokenize, our street name security entitlement shares? There's platforms above those that are saying, hey, why don't we, create an SPV to buy shares from a broker, hold them in custody and tokenize those. There's a lot of different layers and a lot of different approaches to tokenization, but our approach is what we really think of as just native issuer-led tokenization, where we're equipping a public company with the means for their shares to be recorded, the official shares, their canonical ones, the same QSIP that you would trade, on an exchange, as a token on Ethereum and Solana.
No, this is great. We've touched on sort of so many different topics, and I want to maybe kind of consolidate it for our audience a little bit, because we talked about some of the asset classes that you want to tokenize, starting with T-bills. And this kind of touches on the sort of access point of like, who are the users? So we've got a two-sided market here, one side with the issuers and your products, your tokens, and the other side with the investors or traders. And so who do you guys see as your target market on the investor side? And it might be different for these different use cases, I realize that, but what problem are we solving there for them?
Yeah, so I'll start with the two products that have the most traction that we've launched because they came first, T-bills and a higher yielding product. We have about $1.2 billion of AUM in these products today. That's coming from a very, what I'll call crypto native investor base, right? Today, anyone in America, for the most part, anyone listening to this conversation can go out and buy T-bills, and you can probably buy a high yield product, right? Like that's not complicated, right? Everyone has access through brokerage accounts or a bank for the most part. There's obviously some people that are like, don't have this, but like for the most part, anyone who's listening right now, I guarantee you can buy T-bills or a high yield product, right? So that's solved, right? What isn't solved is just for crypto native investors, how do they interact with these products and how do they use them? And what are the different operating characteristics that they appreciate and benefit from? So I'll just use our T-bill product as an example to sort of illuminate the different properties of a tokenized product versus a legacy one, and what type of customers that leads to. And so, for the most part, the users of our T-bill product are crypto native hedge funds, and crypto native projects like stablecoin issuers. And they use the product in different ways, right? Stablecoin issuers generally like buy and hold it. And hedge funds are coming in and out of our product on sometimes a daily basis, intraday basis, a weekly basis. It's up to them. But they're using it because it operates 24/7. And it operates in a way that they can acquire shares either through traditional financial rails like bank account wires or stablecoins. And they can exit in traditional financial rails like bank wires or stablecoins. And unlike a lot of products that, calculate and distribute income by the day, because this product is built on a blockchain real-time back end, it actually is able to calculate and distribute interest continuously by the second. There's some, financial, special sauce that goes into that, which is relatively interesting to sort of enable that. But like fundamentally, it doesn't operate in business days, right? This isn't a product that had to inherit, existing settlement mechanisms. It's a product that could start from a clean slate with settlement mechanisms. And so it operates 24/7 with interest calculated in real time, with subscriptions and redemptions in real time. There's some underlying, complexities there, which is like the actual T-bills can only be bought and sold during market hours, and it leads to a little bit of like, interest, jujitsu. But it's a phenomenal product because it doesn't have to operate with the constraints that people are used to. And so if you're a crypto native hedge fund, you can basically say, I'm going to sell Bitcoin for stable coins and go back into a yielding the risk-free rate in a minute, right? And if I want to go buy Bitcoin again or whatever it is, I can exit the risk-free rate back into Bitcoin and settle up in a minute or less, right? Versus if you think about this in a traditional mechanism, if I sold Bitcoin and I'm a crypto native hedge fund, I would take the stable coins, I'd convert them to dollars, I guess. That process I'd have to go through an exchange or like a prime broker or, stablecoin infrastructure.
One-stop shop.
Yeah, then I'm like, that's an extra day. And then I'm going to like wire it to a brokerage account and that has to clear. And then I'm going to buy a security and that has to settle. And then I like decide to sell the security to go back and buy more Bitcoin. And I go the exact other path. And if you add up both sides of this, we're talking like 4 days, right? Of like inefficiency to do something as simple as sell Bitcoin, own T-bills, go back to owning Bitcoin again. And yeah, you might be able to do it a little bit faster. Some people might do it a little bit slower, but it's days if you go through this like end-to-end process. And so to be able to go from Bitcoin to T-bills in a minute and back out in a minute is actually extraordinarily powerful if you're someone who's an active market participant. It means, your capital efficiency just goes up. And, this is the thing that those types of investors appreciate. And for a stablecoin investor or a stablecoin issuer, I mean, there's a lot of demand for T-bills because they might get, the demand for them to create new stablecoins or issue at 3 a.m. on a Tuesday, or, from somebody that doesn't work in US market hours, they work in foreign market hours. And so just the nativity to the blockchain and the fact that it operates, continuously is a major advantage. And it leads to a very different demographic of investor that's using this type of product.
Yeah. So you just mentioned kind of going to near zero latency as having a big appeal for especially institutional investors because you're not tying up capital. It's a great point. And I'm really interested in kind of compare, contrast, and competition between the DeFi exchanges that you worked on, the current token platforms like Superstate, and then TradFi. So who wins in TradFi versus token platforms? Are you guys going to move share to your platform? And then how do you differentiate versus other folks that are trying to do the same thing you are right now?
Yeah, it's a great question. I mean, when securities are tokenized, who wins is actually complex. Because I think it will enable crypto exchanges, whether it's Coinbase or Kraken or Binance or OKX or any crypto exchange you could find, assuming, the regulatory pieces for them are figured out, but like medium term, it enables everybody to become a venue for traditional assets in addition to crypto native assets. This is something that they're all clamoring for. All the crypto folks are trying to become super apps, so to speak, support any financial, instrument. you know, and I think they're the ones that are going to benefit from this more than, we'll call it traditional financial exchanges trying to add support for crypto. Um, but I think the biggest winners will be crypto native participants. I
Yeah.
think because of that, the ones at risk are probably traditional venues that have close to 100% market share. Seeing actual execution leave their venues, I could see NASDAQ or NYSE being most at risk of disruption. And if that occurs, it trickles back to DTC being at risk. Um, I think custodians are somewhat, but not really at risk. I think if you're, an institutional shareholder or participant, you're still going to say, I need to custody my assets with somebody I trust and doesn't charge me a lot of money and is relatively high tech or high tech for custodians. So I don't think the custody side is going to like change that much when things evolve into tokenization. And, I think at the end of the day, like you know, the we'll call it the broker layer of this, like probably doesn't change too much. Companies are still going to raise capital. Their securities are still going to trade. I don't think the world looks that different, but I think the biggest disruptions are going to come on just where does execution occur? How does settlement occur? And what are all the pieces around the secondary markets?
Yeah. Yeah, no, I think it's a really interesting point because one of the themes of the day is market structure and how tech changes that. And of course, starting point matters. So if you're starting from a really fragmented standpoint, it tends to electronification or virtualization, it tends to kind of centralize things. If you're starting from an already fragmented landscape, it tends to, maybe stay that way or do the opposite. We'll see. So I think that's an interesting
We'll
and key
see.
point for tokenization, which direction it goes in. But really interested in your viewpoint on that. So there's another topic I want to ask you about because we've swung the pendulum on the regulatory environment from kind of challenging to super friendly. And so in your world, you got to convince institutions, you got to navigate regulators, you got to manage crypto Twitter or whatever is happening there. What is the most challenging? And tell us a little bit about kind of how you're positioning vis-a-vis the regulatory landscape.
Yeah, absolutely. I mean, the regulatory landscape has gone from, antagonistic without purpose to supportive in a close to 180 degrees, right? I think to anyone who worked in crypto, I think it's even more pronounced than someone who hasn't been working in crypto, it's not ambivalent to supportive, it's like outright antagonistic and hostile to supportive. I don't think you can get more of a switch in one administration, frankly. I don't think we'll ever see as big of a shift in, the SEC's direction again. Um, but that creates its own issues. I mean, there's, participants in, the incumbent side of financial services that don't want to see change and are actually trying to slow down the SEC a bit or trying to grind the gears a bit, right? So it's not just like a free for all and it's not, a race, without rules. So the regulatory side is great, frankly. You know, they are not at the point of having published all of the guidance that will come out, all of the rulemaking that will come out. They're still in a lot of ways at the starting point. We're barely a year into the new SEC, and they're really just starting to, continue to release, very basic views that are necessary that people have been asking for like a decade now, and like, on different pieces of this market. And, you know, they're in probably like, I don't know, the third inning of the guidance and rulemaking that they're going to provide. So I think there's a lot more to come, but it's a phenomenal starting point, but we're not there yet. And so one of the challenging things is, just waiting. Um, some people probably naively thought like, oh, we'll come like January 21st, 2025, like do anything, like there's a new SEC that wants you to innovate. But, for participants like Superstate and a lot of other institutions, we're still waiting for certain like big pieces of guidance, right? We're still waiting for what the SEC calls Project Crypto, which is, an innovation exemption or framework for tokenized assets to, you know, become operable on blockchains and new environments, and how broker dealers can think about that, and how exchanges think about that, and how investors think about that, and how issuers think about that, and how transfer agents think about that, and all the other pieces. And so, it is a little bit annoying to continue to have to wait. But I know that, with a high degree of confidence, whatever rules and guidance comes out are going to be well thought through and actually enable Superstate and others to do a lot of new things, which are necessary. So that's not the hardest part. On the institutional side, I mean, honestly, there's a tremendous amount of interest in this space. I think we've gone from a world in which everybody felt they weren't allowed to participate to one in which there's, you know, honestly, extreme competition to move quickly. If you think about, the incumbent institutions, they're not necessarily, risk. They don't like to take, too much risk on like being the first of things, but once someone else is the first, they really don't want to be second. So I think we're starting to see that play out. And it's clear that everybody wants to enter this market. Everyone's figuring out how. And I think that the biggest challenge that I see is actually not that everybody wants in, it's that everyone's unsure of exactly what, vector to take as they enter the market, what their product strategy is, what their opportunity is, et cetera. And so, there's a lot of demand from banks, from custodians, from exchanges to work with new entrants, to like build in-house, to figure it out. But we're still like in this moment where the playbook isn't really fully written. Nobody knows exactly what they're supposed to be doing, and it's a little bit of like, fun chaos, I think, for the entire industry to say, hey, we're able to do almost anything we want. There's a new technology here and the government is not trying to tell us no. So then it's like, well, what do we do?
Yeah. Yeah. Well, so you've been a serial entrepreneur. And I think, of course, that's very inspiring. And for folks in our audience, what's the two big assumptions? So one assumption that, really keeps you up at night, you really worry about, and one assumption about the future that you're super confident in.
So I'm super confident. I'll start with the second. I'm super confident that in 10 years, financial markets will look extremely different. And I say this because there's really, three things that are just all colliding at the same time. One, is straightforward, but like everyone talks about AI. I mean, the cost of software is going to zero, and the ability to actually build an innovation in how a system works is becoming incredibly simple and easy. And so, I think the technical barriers to markets changing are going to go away. And instead of saying, well, this has worked for 130 years, why would we change this? Like, I think it's going to be easy to say like, oh, well, we can change this now. Like the switching costs are actually have converged to zero. So AI, I think, is can be a very powerful tailwind. We have at this point, the regulatory, enablement for that change to occur. I think it's coupled with the fact that there's international competition for this stuff, like whether it's, like what Superstate is doing or other companies. I mean, there is a real risk that, things move offshore. We've seen this play out with Coinbase versus Binance. We've seen this play out with USDC versus Tether. Historically, America has not been amazing at, actually capturing crypto innovation here. Like the biggest success stories are not built in America, unlike Web 1.0 and 2.0.
Maybe you'll change
and
that.
and capital markets, 1.0. It's like this is an area where the US has not won, whereas we've won in tech and capital markets historically. So I think that competition, is there, which will pull us forward. And, lastly, I think like we're entering an era where there's enough new, instruments that are being created, and there's enough new activity and new venues and new products that, the competition just on the product side itself will change how markets operate. I mean, the best example of this is, perpetual futures. This is a concept that's extremely crypto native, that's come from crypto, that isn't a product that has existed in traditional markets at all. And I think is going to significantly change and compete with traditional derivative structures for any asset class.
Yeah, huge difference. So we're almost out of time, but I think it would be great for, especially for the students in our audience thinking about a career in fintech. What's the takeaway message from your career, your biggest lesson learned that you'd like to share with this group?
Yeah, my biggest lesson is, you know, it's funny, the things that have worked for me, think carefully about what you want to do and why without chasing like a buzzword. Like there's a million ways to say like, oh my God, like, crypto, AI, like new thing, like let me just like do something. But if you do the wrong thing, you waste your time and investors' time, right? And it's actually not great. And so the one thing I would say is just, focus on doing something that, you know, you've researched and there's really need for. And if and when you do, raise more capital than you think you need. Um,
I think the first bit is a pitch for our fintech classes at Stern. The second pitch, I can't answer that one, but I think it's a great tip. And this has been an amazing conversation. Thank you for sharing your time. You've been really generous. And we all learned a lot about Superstate and about what's happening with tokenization. Really appreciate you being here.
Thanks,
Thank
Kathleen.
you.
Appreciate it.